Welcome back. Some big bellwethers reporting after the bell for the media, the consumer, and the IPO market. We're going to look at Disney, Affirm, and Instacart in today's earnings exchange. Here with our trades is Lee Munson, Portfolio Wealth Advisors founder. Lee, it's good to see you again. Let's kick things off with the biggie, the Dow component, Disney. Moffett-Nathanson calling it deja vu this quarter as investors focus yet again on streaming versus linear, the fate of assets like ESPN, the impact of the actors' strike, and potentially more activism from Trian. All the uncertainty has the stock down slightly on the year, but last week was its second best since January, up 8%. Are you a buyer here, Mr. Munson?
No, it's been my biggest disaster in my book of any individual stocks I've had since the lockdowns. My core thesis wasn't any of those problems you mentioned. They're all real. My biggest thesis was that parks were always going to remain strong. They always had pricing power. They could always raise their ticket prices to help fuel all this other stuff with streaming. That's no longer the case. I think we have a cultural shift where kids have YouTube, TikTok, and a million other things. Do not be fooled by Disney adults. I don't care how much Hulu costs. I don't care when streaming is going to be profitable. I'm just done with the stock. They need the best CFO in Fortune 500 company to help run a company that should run its own. I'm done.
What about when people say, the whole idea of buying when there's blood in the street or when it's hated? I mean, is self-loathing a good criteria for buying?
Yeah, probably, I think, could it pop? Could they beat earnings? Sure. I'm thinking about structurally going forward. I don't think that content is going to pick up the younger generation. So on a secular basis going forward, I think they're going to have a lot of great success, but no profits in streaming. And I also think that the idea that this brand has this huge moat around it and the kids are going to glom onto Star Wars and all the Disney princess, all this stuff, I think that is fundamentally flawed. That was my thesis. And I'm telling you, my thesis is fundamentally flawed. It doesn't mean you can't make money in the next 6 months. I'm saying if you want to hold this for 3, 4, 5 years, you got to believe the brand is there. I don't think the mouse is with the kids anymore.
Well, Julia Borston has an exclusive sit down with Bob Iger at Disney headquarters coming up in the 4 p.m. hour today. We're very much looking forward to how he's going to defend the company's strategy here. Let's quickly talk about Affirm. Buy now, pay later. They could benefit from some consumer weakness, but Compass Point writes high rates should pressure volumes, loan sales, and rising delinquencies remain a risk. Shares have doubled over the past year, still well off the highs. You'd be a buyer?
I'm really interested. Now, I want to be careful. I'm a value-oriented guy. So companies that lose this much money, I want to say buy, but I'm hesitant. You need to do your own research. Here's the thing. A lot of analysts are just so poo-poo on Affirm. They say, oh, it's a commoditized market. Affirm is not a commodity. They have a unique business model. Amazon picked them for B2B for a reason. People don't like math, and Affirm, you at least know what you're into when you're doing these payments. They have flexibility that the Visa MasterCard doesn't. So I think people are analyzing the stock all wrong. The issue, though, we've got to hear from management about operating earnings. We have to see when they're going to turn a profit. But I think fundamentally, people read the stock wrong.
All right, let's move then on to Instacart, legally Maple Bear still. Maybe they can change that. Reporting their first ever earnings after that September IPO. Analysts are concerned about market share as Uber and DoorDash and the grocers themselves are all jockeying for e-commerce. Price-sensitive consumers may opt out of delivery. Ad revenues remain a key factor. Shares down 9% from that $42 opening price, and they're below the $30 initial pricing. Would you pick these up?
I actually like this. Now, I know people think that I've lost my mind. I don't like Disney at a great value, and I like Instacart. It's one of those old .com last mile delivery things. Why are we so concerned that they're only making a profit because of ad sales? I think that's great. You got to figure out some way to make the delivery thing work. Also, Instacart is not DoorDash. Why do analysts keep comparing the two? Instacart is about your local grocery store, and that's where they excel. That's what their niche is. And if you do this, if you actually use the products and stop looking at stock screeners on your Bloomberg terminal, you're going to notice that there's a big difference between that and say a DoorDash. So I like Instacart. I like that they make a profit. I like that they figured out how to make money on something that ever since my .com days, nobody's been able to figure it out. It's quite simple.
Yeah.
Sell ads. Yeah. People love it.
Real quickly, we have to go, Lee, but what about Arm? They also are going to have their first ever report. Would you be a buyer there?
I like Arm. You know why? stop focusing on the saturation in phone sales. What we want to focus on is, are they going to eat Cadence and Synopsys lunch in automotive? And remember, there's a huge growth potential at ARM for servers and the server chipset. We're using something called x86s. That's the sort of the standard, but they use too much power. ARM's all about power plus electricity usage. Please, electricity is going to be an issue going forward. So I think ARM has a game to win, and the other places have a game to lose.
Lee Munson, thank you, sir. Great to see you. We appreciate your time.